Welcome back, everyone. It's not an easy question that our expert panel is about to tackle, but then we aren't here to deal with any easy questions, are we? The topic of this roundtable will be the new constitution of the European Union and its influence on the world economy. You have already met two of the panelists. On the one hand, Jan Schoch, CEO of EFG, as well as Professor Dr. Otmar Issing. Let me also introduce the other panelists. To the very left, Professor Norbert Walter, former chief economist at Deutsche Bank. To his right, you see Dr. Katz, CEO of the division Cash Markets at SIX Swiss Exchange. And please also welcome Jeffrey Anderson. He has been the director of the European Department since 1992 at the Institute of International Finance. Gentlemen, the stage is yours.
Thank you very much. Do you hear me? No? Yeah, now you hear me. Thank you very much for being with us. So the title, as mentioned, is the new constitution of the European Union and its influence on the world economy. The way we have structured this panel is to give you maximum opportunity to ask questions. So we try to involve you very actively in this discussion and with these panelists. We're going to go through each panelist who has 8 minutes to kind of position himself and give us his views about the topic. Then you have an opportunity to ask questions directly right after. If there are no questions, we continue and we'll have a Q&A at the very end after we have tried to gather in a conclusion or lay out different scenarios, which probably is more realistic for this topic. So with that, I will try to set the stage, giving you a bit of background about the dialogue of the European Union and how that has developed. As mentioned by Professor Issing, Kohl already said it would be absurd if we would start a currency union without a political union. Already a very strong statement. And that was, of course, before the currency union was enacted. Nevertheless, in 1990, in April, at the special summit in Dublin, de facto, this idea was let go due to resistance of the UK and France. In 1997, the Stability and Growth Pact was agreed among the 27 members, and it was used to monitor the Maastricht convergence criteria, of which mentioned by Professor Issing, 3% annual budget deficit and the national debt lower than 60% of GDP. As already mentioned also, it was watered down by the very two who started it, Germany and France, and at the end in March 2005 was de facto given up as a guideline. Jean-Claude Trichet in 2007 mentioned at Harvard University at the speech which he held that we need to have fiscal policies which are disciplined in line with the objective of reaching balanced or surplus budgets over medium term. So already that was a statement going in the direction of which we talk today. In March 2011, the European Council enacted the Euro Plus Pact, which was used to kind of be more stringent than the old Stability and Growth Pact of 1997. The goals were to foster competitiveness, foster employment, stabilize public finances, reinforce financial stability, and foster tax policy coordination. On the 1st of December, Angela Merkel kicked off this discussion with the statement that we started a new phase of European integration. And she laid out her determination to create a legally enforceable fiscal union to restore confidence in the Eurozone with strict fiscal rules and automatic sanctions. Sarkozy thereafter said that to defend the euro is to defend Europe, and that he would never give up the idea and the path of convergence between Germany and France, as behind this convergence path stays peace. On the 10th of December, Angela Merkel said the crisis is a chance for a new beginning. She tried to enact this new treaty as a change of the Lisbon Treaty, which would involve all 27 member states. This idea was killed by the UK and the demand of Cameron to de facto have a protection of his financial industry, which was not accepted by the other members. Let's quickly summarize what we know so far about the discussions of the Treaty of Stability, Coordination and Governance, how it was called, in a draft of January 2012. In the EU summit on December 9th, it was said that budget shall be balanced and structural deficit must not exceed 0.5% of nominal GDP as one point. Of course, the 3% ceiling was kept and automatic sanctions were agreed if that would be breached. And as you mentioned, Eurobonds were excluded at that point, and also the banking license of various European institutions. On the 20th of January, so very current, the highest court defined that they would have standardized balanced budgets in the respective countries, and if that is not being put into the constitution or similar character, they kind of watered down that saying of having it in the constitution because there are referendums in Ireland, Finland, Denmark, and Romania, and of course that's a risk to the process. There would be penalties of up to 0.1% of GDP for the respective countries if it wouldn't be introduced. And that penalty would be transferred to the ESM if Denmark agrees, which doesn't look yet like after yesterday's discussion. This treaty is an intergovernmental agreement, so it's not a treaty among all 27 members, and it is designed to be included into EU law within 5 years if the UK drops its veto in that period. Otherwise, it's obviously not possible. The treaty should be started on the 1st of January 2013, or provided that 12 European countries have signed it and have ratified it, or then at the point when this is actually the case ultimately. One statement which was also in there is that balanced budget rules should be set aside under exceptional circumstances, such as unusual event outside the control of the respective government or severe economic downturn. So that's a condition which is being discussed. And last but not least, it is also being defined that the ESM shall start early, a year early, already in July 2012. So that is a bit of background to set the stage. And with this, I would like to ask first Professor Walter to give us your view about the topic and your opinions. Thank you very much.
Thank you. I would not know where to start. I would not know where to end. Probably a little bit better where to end rather than to start with. I believe many of the technical debates we had are short of what is needed. The basic proposition that you shouldn't have a currency union without a political union is a valid statement, and the very fact that we started the currency union without having a political union was something that only could be defended if you believed that the currency and economic union would be an impulse, an incentive to move towards political union. If after a 10 years period of monetary union, even longer period of economic union, and even many years of Schengen area, these European people are still not understanding that the logical implication of any of these steps is political union, they are just stupid. But that's the reality. I believe that what we have discussed and decided upon in December certainly falls short of the necessary. It is a modest reform of something that didn't work in the past decade. But in my view, it lacks the vision that helps people, not just the European people, but the world at large when viewing Europe, of what we are in for. I'm pretty sure that the request to implement as fast as possible what has been decided upon on December 9, without an umbrella, without an idea, without a vision, what comes next? What does this lead to? I believe we won't achieve something. You mentioned some technical, some democratic hurdles that are high, referenda. But when talking about referenda, we only talk about formal obstacles that might stand in the way of executing what has been described as the path forward on December 9. There might be completely different events that derail the process. It could be revolts in the street. It could be strange political developments in the countries that now have caretaker governments, for example. It could be events unfolding in donor countries that are politically probably as delicate as some of the issues to be discussed in Greece or in Portugal or in Ireland for that matter. My fellow economists have a tendency to attack Angela Merkel and our finance ministry on the basis of what I consider an underdeveloped talent of looking into political, economical issues. It seems as if professors of economics and investment bankers tell the leaders of European countries to disregard democratic processes because they are inefficient. That's wonderful. It might be a thought process that is worthwhile, but it's certainly not good advice. I would not subscribe to any of my colleague professors' advice if this endangers the democratic underpinning of Europe. And by the way, I would have to say the same thing to my fellow investment bankers in many cases. So before they continue to attack the politicians, they should first study the political order in which these politicians have to and only can act. If the beloved professors and if the beloved investment bankers, smart and rich as they are, would take this lesson to heart, we would be in a much better world. We would stand a chance to really preserve the treasure of Europe. Europe has a number of treasures. To preserve them is good. To preserve some of the thoughts of Europe, the environmental orientation, to name one example, the social condition of an economic order, to mention another example. These are worthwhile, important elements of the political order of Europe that should be preserved. Without this understanding, I think many of the issues we put forward fall short of what is needed. This was the grand vision. I do have a grand vision. I want Europe to have a political order that resembles the Swiss political order. I want to have a confederation of Europe with strong nation states like strong cantons in Switzerland. But I want the European citizens to understand that without a true and a truly effectively elected common parliament and without a budget right for this European Parliament, we are considered inside and outside as a combination of dwarfs that have no say for geostrategic development. Here in Europe, we have the most powerful economic weight of the world. We have the most important contributor to world trade. We have rich people, we have educated people, but we don't pull our weight because we insist to be considered and to be organized like a bunch of dwarfs that, if changing, only adds a few more dwarfs. That's not good enough. We need a European institutional setup that reflects our strength and the need of Europe to influence geostrategic thinking. That's the grand theme. I have only 2 minutes left. Where to come from December 9 to this grand vision? I understand that the political processes needed will imply more time than until the beginning of 2013 to get the arrangement that we have talked about effective. Financial markets will not even wait until the beginning of 2013 before they again attack. And therefore, we, all the responsible people in academia, business, and politics, have to understand for the interim we need a fire brigade. The fire brigade, for the time being, can only be one institution. It's the European Central Bank. They will have to do something that economists and other well-intentioned people should regard, continue to regard, as an inappropriate allocation of jobs to certain institutions. The central bank is and should be everywhere on the globe, nothing but the provider of last liquidity and the one institution that guarantees a stable value of money. Full stop, end of story. In a situation when solvency issues are at stake, the role of the lender of last resort cannot possibly be the central bank. If they do so, they risk the most important asset of theirs, namely the credibility to guarantee a stable value of money. Therefore, it is very obvious it's a sin to provide the solvency to the financial sector through actions of the central bank. However, as long as parliaments and governments do not deliver, and as long as financial markets have double standards all the time, assessing different countries inconsistently, not the same way, I believe it could be defended for the transitory period that the ECB behaves like the Bank of Japan, like the Bank of England, or like the Federal Reserve, not only as lender of last liquidity, but as a lender of last resort as well. It should, however, be understood that this is a mistake, and this has to be unraveled as soon as one can. And I therefore would strive for, as fast as possible, political action to get the December 9 issues in place to guarantee that the G20 ruling, think of Basel III, is being implemented in all countries, particularly in the one country that has caused the world more trouble than any other in financial terms, the United States. It cannot possibly happen that the United States again does not have Basel III. We should insist that this time the consistent introduction of capital equity ratios is taken care of as soon as possible. Thank you.
Thank you very much. So we have heard a lot of input. People don't understand exactly what the political processes are and seem to be. That lack of understanding makes it obviously difficult for the whole process overall, and that there might be not only formal obstacles but also other obstacles, as you mentioned, like revolts, and it is about to preserve treasures of the European Union, and also ways how to get there, appreciating that it takes longer with the ECB and Basel III capital requirement. With that, I open up for questions to be posed by the audience. Please say your name, use the micro, and also the company where you come from, so that the speakers know a bit more about you. Yep, please.
Thank you very much. My name is Panayota Balfousia, and I'm with ISGAM AG. I wanted to just share my thoughts with you, and very often when the current situation is rationalized, the starting point is a narrative whereby individual nation states, sometime in the past and throughout, have not followed the right policies, and now the ramifications of them not following the right policies are Europe-wide, are global. I think this narrative is not convincing to me, because I think it misses at the start and throughout the global dimension and the interconnected world we live in. And I would like to just perhaps say one thing that's on my mind regarding this. It was said earlier that Germany, for about a decade or 2 decades, has had very low growth of unit labor costs, or zero growth. I think this fact, together with the introduction of the euro, is hugely important. I think it is truly the experiment that has been going on. What has this meant? This has meant, I think, that Germany has had an immense boost in its price and cost competitiveness, and has able to, by exporting, to have huge growth in corporate profits. These corporate profits have tried to earn a return in other countries, in Ireland, in the banking sector, in Spain, in the real estate sector, in Greece, in the public sector, thereby creating what can now be seen to be unsustainable flows. What happened that made these flows unsustainable? The 2007 crisis, which started in the States and resulted in recession in most countries, made these flows unsustainable, because the markets that were the export markets for Germany were not able to continue to absorb the exports at the rate that they were. And therefore, this continued growth of the corporate profits in Germany, and therefore the sustainability of the flows to Greece, to Portugal, to Ireland, was put into huge question. And I think in this context, one can make sense of the fact that a few years ago, if there was a budget deficit, the rating agencies and market participants would not bat their eyelids, but now they do, because they know that the flows are not forthcoming to sustain these deficits and these asset bubbles. And I think this kind of thinking puts the issue of global current and capital account imbalances into center focus. And the key players of this issue is certainly not Greece, not by a long shot. It's the US, it's Germany, it's China. Thank you.
Thank you for your statement. Professor Issing, anything you want to add to that statement? It's a long one, right? Other questions?
Yes. Luc Schurmans, Bank Lind. I have a question to the future on various points.
Probably you
it's
want
a
to stand
simple
up,
question.
please.
What is the concept behind splitting up the euro with regards to the future? Is there, sometimes one hears people talking about a euro Sud and a euro North. Is that a concept which, based on your experiences, addressing it to all the members in front, would work? Because obviously the concept of 1 euro with so many nations behind it is at stake looking into the future. I'd just like to hear your thoughts on that.
I do have a view. I do consider the future of the euro meaningful if the present member states stay and behave according to the concept of a currency union, and if members with similar economic conditions as the ones that had good reason to join the club would continue to join this club in the foreseeable future. I do not expect that the group of 17 is the end of the story. I would expect, if things are put right, that we stand a chance of having 20 to 25 members in 5 years' time. Why would I consider the decision of Greece to withdraw inappropriate? I would consider it inappropriate because the costs for Greece to get on its own feet under such circumstances most probably is more difficult than within the club. However, in my view, if we just continue to think of allowing cheap finance for countries that have been over-indebted in the past as the rescue to the problem, we of course are not doing the necessary. We are doing the important things, but it's not sufficient. What is necessary would be to help Greece to get more tax efficiency, to help them to have a meaningful privatization process. We ought to help them to build up sectors where they do have comparative advantages. The Germans arguing that Greece never could flourish because they never could build special machinery and premium class cars is stupid. It's very obvious that Ricardo's comparative advantage has to be observed here as well. It would be much more important that the Spanish help Greece to build up a modern tourism industry to get them off the ground. This is more important. These more structural issues have to be addressed, and then these countries could be integrated. I would strongly suggest that those who know that nominal devaluation in 2012 still is the answer to the most important economic problems should observe what the devaluationist policy, for example, of France from the middle 60s to the middle 80s helped them to achieve better competitiveness. The only thing they got was a higher inflation. They didn't get the competitiveness. Why Greece should be different is something that seems to me miraculous to me. And I find it interesting that so many people recommend to the Greek to introduce the new drachma, when 75 to 80% of the Greek have not the slightest interest to accept a weak, inflationary national currency of their own. Why aren't the economists of the world not capable of observing what inflationary national currencies in Latin America did? It caused dollarization, and it caused the bank accounts to travel to Miami banks. Amen.
Professor Issing, any statement about Greece? You mentioned it's a hopeless case.
On the consequences for participation of Greece in monetary union, I have a different view, as I explained a few minutes before. On the consequences, the advantage of devaluation, I fully agree with you. Experiences tell a different story. This artificial advantage is wasted in a short period of time. So this is certainly not the solution. On this idea of splitting the euro area into a north and south division, I think it's based on flawed ideas. Even for a moment, even in a, let's say, a South Euro, which is meant as being a weaker euro, a more inflationary euro, even there you need rules. Even there you need rules. You need the kind of same rules. For me, the question is that the euro, as it is based on a stable currency, independent central bank, this is a setup which must not be put into question. And countries who wish to stay within the euro area have to comply with this regime. But if they can't, I think the question of leaving has to remain open, also as a kind of sanction, of a pressure, because otherwise you are blackmailed. If you explain that no country must ever leave, then political processes will blackmail you. Here I have a great concern. And what really strikes me, if somebody suggests that Germany and France could belong to different camps, this is ignoring the whole history which goes back to terrible wars and the whole idea of creating a common Europe. Talking to politicians, I immediately add, this is not an excuse for applying bad economic policies. Because if you take the political project as something which comes first and second and third, then politicians sometimes take the idea, then we have to do everything, even crazy things, so to say, to save this concept. This is not an excuse. I think this political idea has to be combined with good economic policies.
Talking about Greece, Jeff, what is your view on the private sector involvement, which is currently ongoing? Is that going anywhere? Do we see a solution? What is the end of that?
Well, we don't know. I don't know. I think this is a pivotal week, but I thought last week was a pivotal week, and I thought October was a pivotal month, and I thought July was a pivotal month before that, but we do have an important bond payment coming up on March 20th, so I think the clock is ticking down towards zero here fairly soon in terms of what has to be done. It's a very important time because the organization I work for and the creditors who are part of that organization, I think are right in their judgment that a voluntary agreement is really very important going forward, and that the spillover costs of a non-voluntary agreement are things we can all take sort of academic views about now, but we're going to have some evidence for it fairly soon in the markets if it happens. I've just come from doing quite a bit of work on Portugal. I'm actually going to Ireland tonight. So those are two countries that I think of that this matters very much for. We can look at what's happened with the bond yields for the Italians and for the Spanish in recent weeks, and I take some comfort, particularly in the case of Spain, that I think the political support for what has to be done now, we've got a very clear, strong voice in favor of. We had that in Ireland last year. We had it in Portugal last year, and I think those are reasons to be optimistic about those countries, although I'm spending a lot of time talking with people about why Portugal is Greece or isn't Greece. I think this basically comes back to growth records. I think the Portuguese have not had very strong growth since they've adopted the euro. The Irish had very strong growth. I think it's easy to forget. Does anybody know what the average growth rate was for the 10 years prior to the crisis in Greece? If I said 4%, would that surprise anybody? It was about 6 in Ireland. Now, we can all say, well, that was a credit-fueled boom. Obviously, Spain had elements of that, and we can see it in the real estate market. But I think the real issue going forward in Greece, and I have to say, as encouraged as I am by what we see in Rome, we haven't really had the political change in the new elections that's put in place, a solid parliamentary backing for what this very impressive group of technocrats has done. In Greece, we don't have this. We have no kind of consensus right now about what to do. The leading opposition party, which is now part of this sort of interim government, is very opposed to most of what's in the memorandum with the Troika. They are very opposed to some of the basic fiscal things that simply have to be done given the lack of more financing, with or without a PSI, which is voluntary or not. So I think one of the big issues going forward, and this really comes back to my broader view about the euro. Euro to me is, all of this discussion about is it an optimal currency area or not, that depends on if you're looking at early Mundell or late Mundell. He has two different views on it. I sort of set all that aside. It's first and foremost a political undertaking. And I think that's one reason why, the scenario that I have most in mind for a country leaving the euro would be Germany, so that the rest of Europe could have the appreciation of the German currency that would help the rest of Europe to grow. I don't think that's going to happen, and I don't think that's going to happen for the same sorts of very solid political reasons that go back to the founding of the coal and steel community. This is about how to move forward with a united Europe and not go back to the sorts of strains that we had in the past, that led to wars and the like. So what I see going forward for Greece is a tremendous amount of difficulty, because this is the very definition of a negative feedback loop. We have the pressures of the sovereign are feeding back onto the banking system. The banks are actually still amazingly resilient, but really, really suffering under the strain of now 5 years of output contraction. They have had roughly 10% of GDP worth of underlying fiscal adjustment in 2 years. They still have, last year, had a fiscal deficit of about 10% of GDP. If ever I can think of a country that needed more financing in order to have the sorts of investments in the public sector that really need to happen, it's Greece. But it's very hard to get the political consensus behind providing that. Have they done very much on the structural reform side? No. Have they done very much with privatization? Well, not really, but this is a relatively recent thing in Greece. They have enormous potential. My view as an American is that Greece needs to become Europe's Florida. In Florida, if you go back to the 1920s, had a rather dubious financial reputation. It's had a dubious political reputation in more recent times, but it is the place where most of North America, not just the US, goes to vacation in the winter, goes to retire. There are the sorts of tourism, the sorts of tourism infrastructure that frankly Greece lacks right now. They have some very impressive, but if you go to the airports outside the new one in Athens, you're really struck by this is not a place that compares favorably to Spain, Portugal, even Turkey, which has made great strides on this over the last 5 to 10 years. So we need to see what happens. I think it's a critical week going forward. It doesn't help that Europe's in recession now. It doesn't help that the credit mechanism for banks in Europe and banks in North America, still as a result of the crisis, is still broken. Basel III is important, but Basel III in combination with all of the other things that are being done, all of which make sense by themselves, but you accumulate them all together, banks have a huge incentive not to lend. And very little incentive to lend. So interest rates being very, very low. If you have those companies with the balance sheets that have been so greatly improved, we still have households that are very heavily indebted. We have governments that are very heavily indebted. We're going to have fiscal rules that make sense, again, sort of like the individual pieces of Basel III in isolation. But put that in right now. Does Europe really need accelerated sort of fiscal contraction everywhere? I would argue probably not. It certainly needs it in those countries that are under stress, but to the extent that it's going to get it everywhere, it's going to make it more difficult for the countries that are under stress going forward. So this is a pivotal year. There are some sort of positives in all of this. Certainly if you look And some of the big uncertainties is, are the firewalls there? Do we have adequate financing to deal with Spain, to deal with Italy? We've got more sort of positives on this if we're going to have the ESM run in harmony with the EFSF for a year. That puts forward more money. If LTRO2 is really equivalent to what I've been waiting for, which is QECB, then maybe if that's an important part of sort of easing the stresses and for those governments that are beginning to make progress and can sort of keep access to the market, they can do so on less expensive terms. But I think we really have to still say, if the Italians are borrowing at 6% and the average stock of their bonds is about 4%, they have to do about 0.5% of GDP a year worth of fiscal tightening going forward for a long time. Now, that's in line with the Stability Pact. That's what we all expect. But it's not a positive growth environment. Growth is going to have to come from the reforms, and this is going to take time to sort of feed through. So we're waiting for confidence. We're waiting for growth. And I suspect we're going to be waiting for a while.
Thank you.
I've got a question, if I may,
please,
for the whole panel. Athanasios Ladopoulos from Swiss Investment Managers. We run a hedge fund. I'll do a very simple question, which I think the whole panel will be able to answer. I'll set the background first, very quickly, and then I'll go through to the question. Fiscal austerity seems it doesn't work in the peripheral countries. You cannot have growth if you have high taxes, you have less disposable income, and the SMEs, which fuel the growth, if the government doesn't spend, don't invest and don't employ people. Monetary loosening is not working right now. We moved from the 3-month repo rate to 3 years, 1% interest rates. The banks get money and they deposit back the money to the ECB, not fueling into their economies. And then we have the write-offs. If Greece takes the 50%, God's will, if they do, that will go 120% with a deficit that is running every year. It's just kicking the can every year down the road because you would need to borrow more money, more money. Italy, if it decides to write off 10%, will make the Greek write-off like peanuts. So reality would be that these countries, the peripheral, would need support to grow. So growth. Would Germany allow competitiveness to leak out of its borders? Spain, Greece, Ireland, they can still build BMWs. They can still build bridges. Would Germany allow competitiveness outside their borders? Thank you.
Jeff, question to you.
Well, I would just say we've got some very strong evidence of that. Go to the Czech Republic, go to Slovakia, go to Poland, and you'll see, where that kind of investment has gone to, and that's happened because the structural reforms are in place, the business environment is in place. The Hungarians, notwithstanding, the macro policies have provided, pretty sound financial stability. So it's been a good environment to invest. That really has to happen in Greece. I think it's already happening in Ireland. Look at the growth of Ireland in the first half of this year, and you'll see that the exports are really booming. This is entirely because of FDI. A lot of it from U.S. companies that are trying to avoid a very high tax regime in the U.S., but it is really one reason why the markets, I am absolutely convinced that the markets have put down Irish bond yields to where they have because they think growth prospects in Ireland are strong. And they think it's strong because of those sorts of foreign investments.
I'd like to say a few words about the myth about Germany. I don't understand why every piece of analysis about Germany starts in 1995. There was a little thing happening at the beginning of the 90s that the world regarded as our German job. The competitiveness of overall Germany through unification was dramatically compromised. We entered the European Currency Union with a completely inappropriate exchange rate, with a complete uncompetitiveness of the German workers and the German factories. What has happened after 95, 97 until 2005 was a correction, and the correction was so successful that we probably were overshooting. I would strongly recommend the world to very attentively observe what has happened to relative unit labor costs in 2008, 9, and 10. Germany's unit labor costs increased substantially faster than anybody else's. And I don't complain about that. I considered that the German policy of preparing for difficult times, for crisis, was very appropriate. And to use this potential, then to not fire people and to not reduce the employee's income in a time of crisis was exactly what was very helpful for the domestic stability of Germany and for the stability of much of Central Europe over the last several years, over the last 3 years. I don't understand why the latter part of the observation and the part of the observation between 1990 and 95 is disregarded when international economists that are Nobel Prize winners of economics look at Germany. A. B. If Germany and Spain and Italy are countries that are aging as fast and as dramatically as does Japan, we are entering into a phase that Japan already has entered into. I would strongly recommend to the macroeconomists of the world to study Japan. They've had a 20% household savings rate in 1990, and today they have a 0 savings rate of households. In 1990 and until 2005, Japan had an export surplus of above 5% of GDP. They now have seen the first current account deficit. The demographic changes are a natural thing that changes the savings rate of these countries and that changes the current account balances of these countries. If the damned Americans are paying the old age pensions of the Germans in 2020, we are ready to buy our Porsche today by ourselves, the ones that we produce. If you help us to then pay our pension, that's international rebalancing. I'm not advising that, as you may realize, because I don't expect the Americans paying our old age provision in 2020. I strongly suggest that everybody takes care for himself or herself. And therefore, I strongly recommend that we build up systems that are stable, even considering the demographic changes that are in store. And many of the countries and many of my fellow economists are unwilling to study demographics and are unwilling to study the implications of demographics. And the investment bankers are likewise. They are interested in quarterly results. They don't understand that the trend of the yields in capital markets is destined to go down to half the level they have had between 85 and 2005.
Thank you. Christian, to you, what is your view on the topic?
I think to take it one level up again, otherwise it's going into a football match, Greece versus Germany, and I don't think that would be fair, also in line with the comments from the lady from ISMAC. I think a few things became clear. First, the unanimous voting model of Europe as it is today is probably not going to survive. It is what you say, like putting democracy into the European Union from a national level. I think several points in history, unions of countries have not survived when everything had to be unanimous, and the way that, even just listening to representatives from Europe, it becomes clear that that will be very, very hard to implement, whether we're talking about referendum, whether we're talking about fiscal strength going through a crisis. I don't think that is going to survive. The other thing that becomes clear, I believe, is that the central bank independence is compromised in many places. I think in the US it has been very compromised. In the UK, I think the ECB is trying to remain independent. Maybe they have to be a lender of last resort and of last solvency. It sounds a bit like the lender of last hope. I hope they manage to break free again from this very soon. And I think the other thing, taking it a bit away from Europe, is that there's also a clear trend that there are excess funds in the world being generated in regions like the BRICS, whereas there is a lack of funds in certain parts of Europe. And I think that so far it has been maybe underestimated what role the IMF could play in bridging those funds from the excess part of the world into the needy part of the world, which is Europe, which the longer it lacks a political clear vision and leadership, the more it will be required to have some other institution make that bridge. And I think we might find out that the IMF is at least going to hold a very strong helping hand out to Europe. But I think also, talking about the markets, right, I find if I look at the different asset classes today, I think the mother of all asset classes you need to get right is FX. Obviously, it's like the price of a nation, or a union in this case. And I think they've been very, very volatile, except for countries like ours, which fixed it to the euro with a lower level. So I think the first thing to watch is calming FX markets. The second thing that becomes clear, I think, is that equity markets are signaling to us that the point of maximum fear is already behind us. Usually, equity markets lead the real development by about 6 to 9 months, at least over the last 80 years, that's been the case. So maybe this was just the last point of maximum fear behind us last year, and there's a next one coming. But I think so far the equity markets are actually telling us that all these bad scenarios have more or less been factored into most of the calculations. Then the next market, I would agree with you, is the interest rate markets are basically telling you we're in a Japanese situation, full stop. Rates are so low. Then maybe they half again from where they are, but I think the market is telling us on the interest rate sides, like we are already in a Japanese trap when it comes to the European Union. And I think the interesting part is because, some of us are very young. I actually sometimes feel I'm old when you talk about Martin Feldstein, and I remember his article he wrote in the 90s before the euro came together. But I think the credit markets are giving you very interesting signals. Not only are corporates affected negatively through the crisis, now the banks, of course, now sovereigns, and ultimately even supranational organizations like the European Stability Fund, Financial Stability Fund, has just suffered a downgrade. So I think we have to get used to the fact that credit is going to be all over the place. We've had years and years of convergence driven by the euro, which was supposed to push this political union in Europe. Today, credit markets are diverging, and I think you will see more and more cases where a corporate has a higher rating than the underlying country where it is located. It happens usually in credit dislocated markets, like in 1998 in Russia, and I think we will see this again. Then second lastly, I think when you look at the VIX as a volatility gauge, and you have a lot of people saying, no, volatility is huge, it's unprecedented. No, it's not. Look at the VIX since the early 90s. There have been 4 phases of roughly 5 to 6 years. First, a low volatility, that's a VIX below 20, and then there have been 5 to 6 years with a VIX above 20, and then again below and again above. And I think we're now in the 5th, 6th years of high volatility environment, but it's not unprecedented as we had in the 90s when the pound and the lira got attacked. These are times we can get used to again, and just be aware these high volatility and low volatility periods can be just maybe longer than recent memory suggests. And I think the last one is that correlations between these asset classes, the old risk models that had kind of like a even correlation matrix to persist for a long time, for you mostly as asset managers, I think those times are over. We have learned that in terms of upside swings and violent downside swings, correlations change dramatically, usually converge. And so, we're looking at very higher correlations of these assets. And I think this requires new risk management models, new risk management tools. And we as an exchange trying to, churn these out and enable things like gold as a currency, collateralized structured products, covered bonds, which are being issued now at a very intensive rate, trying to do that, but I think that's necessary for you as you try to navigate through the crisis.
Thank you. In light with the discussion around fiscal union, there's also the discussion about financial transaction tax, which Sarkozy brought up, got support by Germany, and now it seems Italy is also not heavily against it. What do you think about that? What is the impact on European competitiveness? Is it an opportunity for Switzerland?
I think it's an interesting question. You should ask that, because when the Tobin tax came up as an idea to save the world, it was kind of strange, because I think most academics would today think that the Tobin tax as a concept is not really such a great idea. And then came the financial transaction tax proposal in Europe. And again, initially, my fellow market operators and a lot of bank colleagues as well, they thought like, this is never going to come. I mean, the idea itself is like so silly, but I think the will seems to be there to get it through. I think there's a little misconception by those countries which don't have a financial transaction tax that actually brings a lot of revenues, because Switzerland already has a financial transaction tax. It's called the stamp tax. It's the same thing. And UK also has a stamp tax. What have we learned from those countries which actually have had a stamp tax? One, you basically, when you have one, you want to get rid of it very fast. And Switzerland's been fighting, we've been fighting to get rid of it simply because we think it really accelerates growth, because capital markets become more efficient again, and it's cheaper to finance your own business. Secondly, which has been a problem in the UK, is once you have such a financial tax, you know, like the stamp tax in the UK is prohibitively high, and so it drives everybody into the OTC business, okay? So you go away from trading on exchange, you try to take the same bet, but not at an exchange-traded product, or something that does not get taxed. In other words, in the UK, you go to the betting office, right? You take a CFD. First you make a CFD on, or you take a bet on Manchester City versus Manchester United. But these days you take a CFD on the FTSE, you take a CFD on a single stock. You start betting everything. In other words, you drive the market from a regulated environment into an unregulated one. And so the betting business in the UK is huge. The combined market cap of the 3 largest betting offices in the UK is much bigger than the London Stock Exchange Group. And that's the consequence. Do I think it's a very smart idea to put it in? No, I think the revenue estimates are overestimated. Business will move. It's going to be a medium to long-term effect for business to move away, because they will try to tax it at source. So a German pension fund gets taxed in Frankfurt, say, regardless of whether they trade in Zurich, in London, or in Frankfurt itself. But I think ultimately, you know, the market will try to move away from it. So is it a big opportunity for Switzerland? I think not in the medium term, in the long term maybe. So short term it doesn't. I think it'll hurt all capital markets in Europe to some degree. Do I think we should follow? No, we have it. We're trying to get it out of the system, of the legal system. Step by step we're going to put it through Parliament. And I think ultimately the idea, though, that somehow the banks should pay and markets, the financial, like Wall Street should pay for what it did to Main Street, that idea is hard to get out of people's heads. And I think to some degree we probably have to do that. And I just don't think it's a very smart instrument to do it. There are other ways to tax institutions involved in certain activities. So you know, we're watching it with a lot of interest, but not with a lot of love.
Thank you. Professor Issing, is there an alternative at all to political union in Europe?
What Norbert Walter has described, and he called it the vision for the future. I have sympathy for that. I was one of those in the 90s who were believing, and I have published that starting with multi-union before political union is putting the cart before the horse. But then in January it started without political union. Then the question was, I call it too early born baby, What can we do to keep it alive and to make it thriving? So I think what has this panel shown to me, first referring to you, is that the disaster which has happened in unregulated financial markets has created a very strong antipathy with the people and politicians to financial markets in general. And now the reaction of regulation, etc., might go the wrong ways. And I think the financial industry is partly responsible for that, because they have not made own suggestions to what extent we need financial markets. We need them badly. No real economy can thrive without functioning financial markets. But there is a part of financial markets which is decoupled from that. And I think to regulate the financial sector in a way which doesn't do harm to the financial system we need badly, but is able to regulate the other part. I think this is a challenge. And what we see now is probably using transaction taxes, etc., taking wrong rules. The second reaction to the panel here and the questions of the audience is, and this is related to political union concept in Europe. I think what is, we have to be aware what is needed in crisis management and what is the long run concept. This is not just in Europe, it's everywhere. And the third element is, the focus is now so much on Europe, but this has to be seen in the global context. In the global context, and I agree with Norbert Walter that demography is a totally underestimated element, and this is something which is exogenous, which is already in the pipeline, and reaction to that. So combining crisis management, having concept for the future of the euro area, for Europe, for Switzerland, for all countries in the global context, I think we have to really separate, and you have done it, we have to separate volatility, which is present, etc., which is always not seen in the historical context, from long-term trends which will come anyway, and to make the system more resilient to this challenge. This is the question. And if you look from such a global perspective with trends in mind, then I think it's obvious that the euro area and the euro has to play a substantial role as a stabilizing factor. But for that, a lot still has to be done.
Do you believe we do the right things currently? Do we improve the competitiveness which you criticized of a number of countries which haven't kind of improved it in the past? Do we kind of heal the causes for the crisis with the treaty and other suggestions?
The glass is half full or half empty. A lot has changed, a lot is going on, and there's reason for optimism, but it's too early to claim victory. Every step in summits, etc., at least hasn't gone in the wrong direction. This is already I think a positive message, but it's always too little, too late. But this is a complicated process. And finally, we live in democracies. If you have 17 governments with coalition governments in separate countries, this is a process. And here, Norbert Walter is called the population stupid. I think people are not stupid. They still want to be convinced why Europe is such a good idea. And what my concern in first place is not economic, it's political. the declining support in Europe, in Germany, and in donor countries as well in receiver countries. I would not have expected that more than 50 years after the Second World War, let's put it that way, the Germans would again be described as Nazis, etc. And this is not just in Greece. It's in the media in quite a number of countries, which shows that all resentments have not totally disappeared. And now going in the direction of a political union, it's not surprising that these fundamental resentments are coming up. We have to meet this challenge. And for me, this also shows that financial help, I don't know how it's in Switzerland. We have seen it in Germany after unification. You see it in personal relations. Financial help over time does not create a good situation. Those resented who give and those resented who receive. So I think the message that Monetary Union, for example, is a union in which finally countries are responsible for their own policies. And here what Norbert Walter stressed again, I have done it before in my speech, is that it can be done. It can be done. It can be done. It's not, of course it takes time to bring down unit labor costs, to revive growth, etc. This is not something which is out of politics. But you have to react to this challenge in a proper way.
Clearly, we're trying to introduce a European Union at the low point of the feeling being European. There is certainly not as much support currently as it was 5 years ago. Lonnie, question from you?
Just a couple of observations. Can people hear me? There was something that was initiated in the late 40s called the Marshall Plan. The Marshall Plan was unequivocally donation, financial contribution by the US to Europe, without which Germany would not be the dominant economic, perhaps political power in Europe. I think the issue you've got in Europe today is not necessarily so much focused on a problem of dwarves and too many dwarves. The question is the biggest dwarf going to dominate all the other dwarves? And in the land of the blind, the one-eyed is king, and I think at this point the one-eyed is Germany because it's the only country that has money. The issue of political versus economic union, I think, is a very important one. What I would point out in the US, you've got political union, and if you've got political union and economic union, you can blow up the entire world if you've got the biggest economy. The US tried it, has political union, that wasn't solving the problem. So I think we have to some extent entered a red herring by saying the political union has got to go first. I think what we have today is a much more important issue that is short term, that has to be addressed, because if we don't address it, nobody's going to want to go the direction of political union. The problem right now is Europe as a whole has gone to a fundamentally pro-cyclical mode as opposed to an anti-cyclical mode. Absolutely everybody has felt over the past 10 years that government policy should be anti-cyclical, not pro-cyclical. Regulation, fiscal discipline are all items that are moving in a pro-cyclical fashion, where you yourself just 3 to 4 months ago felt that Europe as a whole is going into recession. Quite possibly Germany is doing the same thing. My question is, can you encourage virginity and at the same time give birth to children? I would argue you cannot. Either the Europeans must decide to go pro-cyclical or anti-cyclical, and that's a choice. It's not a straddling. Can we do that?
Thank you.
Germany's debt to GDP ratio as an aging country, measured in the wrong way, i.e. not calculating the implicit debt of the pension system and the healthcare system, is 80% of GDP. Reinhard Rogoff have told us that somebody who tries to push the string at a level of 80% of debt to GDP should expect an inefficiency of one's measures. If one waits until aggressive speculators have decided that this is the case, then you end up in Italian or Greek circumstances. If you want to do so, do it. I would not recommend it to any sensible institution. Another word. There is a big country, almost as big as Germany. It does not belong to Euroland. It has decided for fiscal restriction that is a multiple of the restriction of Germany's restriction. It is called England. Does anybody, despite the fact that they have the free exchange rate to do all the good things many people claim that could be done by the exchange rate, why to hell did Cameron and Osborne do what they do? Why does the American community and journalism not address this issue at all? I'm not criticizing Cameron and Osborne. I think they have done the right thing. If you have lived beyond your means, you should correct. We should not only consider that there is a cyclical path. I agree, we have practically no alternative but a cyclical path down. And we will end up with a lower trend growth rate, because if we lived beyond our means in the past, now the only way is to correct. We cannot but reduce the financial sector in London, Zurich, Frankfurt, New York. We cannot but reduce the real estate sector in Spain, in England, in Ireland, in the United States. There's no alternative. It's very obvious that only a downward correction rebalances. If we don't have any full compensation in other sectors to compensate for this decline, we will have GDP growth at lower levels. And I guess that's the most probable outcome. There could be dreams. I do have dreams. My dreams are, if the world would understand that healthcare is a growth sector, if the world would understand that education of older people is a growth sector, if I would observe a world that understands that it is much safer if we have alternative energies and if we have more energy efficiency and we would invest into these areas, we indeed could compensate much more than we do. And I would recommend private money, not particularly government money, private money that is available in huge sums and sits, and this Pfeffersäcke sit around on their liquidity, and they don't invest in any of the areas that I've just described. And if I would suggest that we should build bridges, I would not recommend to do this in Italy or in Spain. I would recommend to do it in Indonesia and in Vietnam. But in order to do that on a safe basis, we should help. We, the old world, should help that the new world, the emerging world, has good governance or develops good governance. I'm really considered about the overall demand, but to recommend that aging countries with relatively good infrastructure should spend more money, I always would ask people, look at what the Japanese did with this wonderful American advice over the last 20 years, with which result? The result is 250% government debt to GDP and no dynamism.
I mean, maybe, I think the question is a very, very good one between cyclical and anti-cyclical, but if we take it back to what was said here before, that probably the model in Europe that you need unanimous support by every single member of the European Union to change anything, this is a dying model, right? There's no much hope that this decision-making process will survive. So the question is probably, how much pain do you need in order to get political will to change the model? And I would suggest that the contractionary policies and some of the pressure that's being put on the banks by politicians is part of creating that pressure. I would think that the points of maximum fear we had in the last few years were not enough yet to forge a somewhat political and fiscal convergence and some democracy that works for the European Parliament, not just in every member state. So I think the pro-cyclical nature of what is being done in some instances is part of the process of creating this historic pressure to break up the unanimous decision-making model of the European Union in order to save the European Union.
Thank you.
Two sentences or two observations. First, the cyclical challenge that policies were wrongly applied, I agree with you. But the concept of the Stability and Growth Pact being the main message in normal times, the budget should be balanced or in surplus. Then you have 3 percentage points of GDP for letting automatic stabilizers work. This is a concept which is not pro-cyclical, just the opposite. The application was in some countries pro-cyclical, and now with all the indebtedness, countries are in a situation that you have to consolidate irrespective of the cyclical position. And on the Marshall Plan idea, I will not discuss to what extent really German restructuring, it was helped by the Marshall Pact, no doubt about that. But people forget, and now there's the idea we need a Marshall Pact for Greece, etc. One should not forget that Greece, over many years, got help from structural funds of 2 percentage points of GDP. 2 percentage points of GDP every year. Every year. And if you travel in Greece, you know where it went. So, saying we need more money for, so to say, restructuring and creating growth, first you must have the incentive structure right, that the money is not wasted, but goes in investment which is really bringing returns for the country and investors.
Thank you.
Just a quick comment on the political union. I work about a block from the White House. I don't think I've ever seen a less effective political union in the U.S. than at the present time, and I don't think we have, I don't think the policy gridlock in Washington is any less than the policy gridlock in Europe. It's just, you don't have to look to as many places to see it in the U.S., perhaps. The real core here, to me, is do you have the political support throughout all of the various different parts of the political process in favor of sensible economic policies? We're in a mess right now in terms of having to use pro-cyclical policies because we used up all of the leeway for counter-cyclical policies many times over. In part in the U.S., that's because we decided to fight 2 wars without paying for them, which is, by the way, where we were in the 1960s. So we're, in some sense, in a completely different environment, reliving some of the consequences that we had at the end of the 1960s, hopefully without the same consequences in terms of inflation, because we have learned some things about how to manage market economies. But the last point, just because I'm an American, I'll say one thing about the Marshall Plan. My memory on this, if you sort of move away from the history books telling us about what a magnificent moment this was for Europe because of the generosity of the Americans, my memory is that this was actually pretty good for the American economy. We exported a lot of goods to Europe because of that we wouldn't have been able to otherwise. And the post-war economic problems that we had in the U.S. would have been far greater without it. So we shouldn't overdo the lack of self-interest in that. And that's actually, to come back to this point about the structural funds, which are still there and still not drawn upon. There's an awful lot. There's something like 20 billion euros worth of undrawn structural funds. The Greek public administration simply isn't efficient enough to figure out how to come up with projects that can actually tap into that money. It's not that it's not there, it's that they haven't figured out how to organize themselves, how to use it. In the same way that they haven't figured out how to organize themselves to collect taxes in the way that they need to. It's the same basic issue, I think.
Thank you, Jeff. I think you truly deserved lunch. So to summarize, there's a treaty which is being discussed. I think Mario Monti's demand that this is going to be signed end of January is probably not going to happen. It's probably going to be March or later. There are a number of issues ahead of us, functional but also political. Let's remember that there are elections in France in April, that Germany might lose power. What does that mean to the political union process? It might be a setback if it would happen. But I think in general, we agree that we go the right direction. It is the thing which needs to happen. There are the questions if the measures to protect the way or the bridge to kind of ultimately get there are strong enough, if the ECB is going to do what is needed, and if the ESM is going to kick in early enough. that is still to be discussed, and also if Greece restructuring is going to be successful and not, on what that obviously means for the world economy. But given that we are moving in the right direction in the midterm, certainly not in the short term, that should be a positive momentum. With that, I thank you and I wish you a good lunch.
Gentlemen, thank you very much. Give an applause to our panelists, Professor Walter, Dr. Katz, Jan Schoch, Professor Otmar Issing, and Jeffrey Anderson. And as mentioned, it's after so much brain food, time for some real food now. It's time for lunch. Please make sure to be back in about 45 minutes' time to hear from Dr. Paul Wilmot what it is that drives him so